Good morning, everyone. This is Marshall Gittler bringing you the morning comment for July 9th. The risk-off mood continued yesterday with little apparent catalyst. True, the European data wasn't all that great. Germany's trade figures for May were disappointing, and UK industrial output unexpectedly fell in May. But these figures were hardly enough to account for the large falls in all the major European bourses yesterday. The US data, on the other hand, was relatively good. Job openings rose when they were expected to fall, and consumer credit surged once again. But that didn't stop U.S. stocks from falling, bond yields moving lower, and Fed funds rate expectations retreating. Once again, the peak in rates was hit on payroll day last Thursday, and yields have declined ever since, while Fed funds rate expectations are now almost back to where they were the day before the NFP. We can't even blame it on the increasing tensions in the Middle East, as Brent this morning is back to levels last seen about a month ago. Against this background, though, currency movements were surprisingly muted. The dollar opened this morning in Europe little changed against most of its G10 counterparts. It's notably stronger only against the Norwegian krone, while weaker against the New Zealand dollar, Japanese yen, and Australian dollar. The Kiwi may be gaining on momentum after yesterday's modest upgrade in outlook by Fitch, while dollar yen usually moves lower when stocks fall. The risk-off environment should be negative for the Canadian dollar, the Norwegian krone, and the Swedish krona. These are the currencies that are most highly negatively correlated with the S&P 500. That is, dollar CAD, US NOK, and US Stocky tend to rise when the S&P 500 falls. The focus today will be on the release of the minutes from the June 17th to 18th FOMC meeting. The market will most likely be looking for any indications of when the committee members think it'll be appropriate to begin raising rates. I also hope to get some insight into the FOMC's slightly more hawkish rate forecast. Now, expectations for these minutes have been dampened somewhat after comments overnight by Minneapolis Fed President Coachella Lakota, pardon me if I didn't pronounce that right, and Richmond Fed President Lacker, who both expect relatively slow growth and saw little risk of inflation overshooting. In my view, these comments set the market up for a dollar-positive surprise because the market's now probably more poised for a dovish view than a more hawkish sentiment. But don't forget, this was the meeting where they raised their expectations for interest rates. Now, we'll get further clarification next Tuesday and Wednesday on the FOMC's or the Fed's view when Fed Chair Janet Yellen delivers the twice-yearly report on monetary policy to Congress. For more information, including technical analysis, please read the full comment on IronFX.com. You can also follow us on Twitter, like us on Facebook, subscribe to our YouTube channel, or circle us on Google+ to get more trading ideas. This is Marshall Gittler, Global Head of FX Strategy at IronFX Global, wishing you solid trading.